Regulation, why? Well, we have to have a cash flow statement because AASB 101 paragraph 10 tells us we've got to have a cash flow statement. So it's not a choice, you've got to put one in. Why we've got to put it in? So cash flow information provides users of financial statements with a basis to assess the ability of the entity to generate cash and cash equivalents and the needs of the entity to utilize those cash flows. 107 sets out requirements for the presentation and disclosure of cash flow information. So what we've got there is ultimately, and the objectives are around user information, around primarily investor information, is we want to be able to look at that company and figure out how it generates its cash and how it uses its cash. So we want to be able to come up with what its future cash flows are. We want to be able to value the company and come up basically with a firm valuation, which is something that you will look at next year. Because profit, if you're doing a finance major, you know that they really don't pay a lot of attention to profit. They look at cash flows. And so the cash flow information, or at least what the board thinks is the case, and I think it is absolutely true, is that the cash flow statement will more readily help you figure out what those numbers are. Now, if you've ever tried to buy or to compare private health insurance, if you've ever tried to compare the differences in mobile phone plans, you will know that it's really difficult to get consistent information. Like, they've got different types of packages. Some will bill by the 30 seconds, some will bill by 60 seconds, some will bill by the second. They'll have different amount of data sitting in there. They'll have different free calls to people on the network. Like, they don't do it on purpose, but it is really difficult to get an absolute comparison between different things. Private health is the same. They'll have slightly different weightings in what they do and the benefits you get. So an absolute like-for-like comparison becomes very difficult. And the same thing, I suppose, here is that what makes a comparison easier and what makes being able to garner information easier is if it is presented in a way which makes that information much more readily visible. So option A, what we've got sitting here, is going to be exactly the same information provided in option B, but it is just listed in whatever order I felt I'd throw it in on the page at. And it tells us all the same information, and it tells us that we end up with a cash inflow of $410,000. But we've got to spend a bit of time and energy, and admittedly with this example, it's not that complex, so we should be able to pull it out fairly easily. We've still got to expend some energy breaking it down and figuring the things out from it that we want. Whereas this is that same information set up in the way that AASB 107 requires, and it's easier to get your head around what's going on. You can see that operations, it is slightly cash flow positive. So, it's not great, but so of the $150,000 of customer receipts, they ended up with net cash inflow of 10. So it's not, a great number there, but we can see that quite easily. We can see that they sold off some property, plant, and equipment, and they made a lot of cash from that. We don't know if they made profit on it, but we know they got cash from it. And we can see that they bought back shares, and to do that, I'm assuming that was what was happening here, they borrowed money to buy back shares. So it's a lot easier to pick all that information out than setting it up just like this. It's the same information, it's just presented differently, it's easier to use. Or at least I think it's easy to use. But that's the underlying reason why we have the regulation, is to make that information a lot more comprehensible to somebody looking at it. So the definition of cash is not a major issue. I mean, definitely not for us, but there are going to be situations where it does become a little bit of a concern, but overall it's not that much of a concern. Classification aspects and the disclosure and presentation, these are key aspects of 107, so we need to have a look at what these are. So AASB 107, the cash flow statements. Paragraph 6, what cash and cash equivalents are. So cash are short-term commitments. They're readily convertible into cash, and they have an insignificant risk of value change. So property is obviously not cash. I mean, property is obviously something else, but it's not cash. You can't, there's going to be value change. It's definitely not readily convertible. Cash in a bank, it's cash. I mean, you'd like to hope that it is. Shares, well, you could argue that they're short-term commitment, like there's no, I don't know, I mean, are they short-term commitments? They're definitely readily convertible into cash. I'd probably hazard that for most shares there is not an insignificant risk of value change, so that would knock them out. Not for answering in this subject, or you're not going to be asked a question like on this sort of thing, but if you had cash sitting in a bank account in a foreign country and the exchange rate historically between that country and your country has fluctuated wildly, would you consider that to be an insignificant risk of value change? Because that's cash. Like you're holding their currency, but would it, maybe there's further information looking through paragraph 7 to 9, but is that, like, you know, you think it's money, I've got it sitting there, but I don't know, maybe you'd have to look at a little bit more detail about what that says. And these aren't sort of questions that we'll be focusing on within here and now, but you start to realize, hang on, it's not quite as cut and dried. It also excludes movements between cash and cash equivalents. So if you've got something which is a cash equivalent and you get out of that and turn it into cash, that doesn't count as a cash flow. You kind of imagine, may not be the best analogy, a group situation. So it's, instead of company A and company B all within the group, you've kind of got cash and cash equivalents. They all sit within cash and cash equivalents. So a movement within is not a movement into cash and cash equivalents or a movement out of cash and cash equivalents. Paragraph 6, we look at operating, investing, and financing cash flows. So we report cash flows by operating, investing, and financing, which is why you see the structure that you do. Paragraph 10 requires that we show operating, investing, and financing, which then begs the question, what fits into which item? Operating cash flows, I mean, most of these are fairly self-evident, but they just show you how well the company can generate cash. From sales, how much you pay your suppliers and your employees, tax we'll come back to. But you know, you sell stuff and then you have your just standard expenses, which will end up in cash flows that you're paying to run your business. And so cash flow from operations will help tell you whether or not your business is, I suppose, operating well. If it's negative, depending on the life cycle of the business, I'd say it's probably a bad thing, but again, it could be a startup and you're not going to get much in the way of sales. Investing cash flows, expenditures on resources to generate future income and cash flow. In a nutshell, are you buying property, plant, and equipment? Are you selling property, plant, and equipment? I mean, it definitely worth looking at paragraph 16, but that's mostly what we'll be concerned with.